How does the ECB control inflation in Europe? Have you ever wondered how the European Central Bank, often referred to as the ECB, keeps inflation in check across Europe? It's a fascinating process that involves various strategies aimed at maintaining price stability. The ECB has a clear target, an inflation rate of 2% over the medium term. This target is measured by the Harmonized Index of Consumer Prices, which helps preserve the purchasing power of the euro. One of the primary tools the ECB uses is setting key interest rates. By adjusting these rates, the ECB influences how much it costs for banks to borrow money. When the ECB raises interest rates, borrowing becomes more expensive. This tends to reduce spending and investment, which can help lower inflation. On the flip side, if inflation is too low, the ECB might lower interest rates to encourage more spending. Another important method is through open market operations. This involves buying or selling financial assets to manage liquidity in the market. For instance, when the ECB sells assets, it can reduce the money supply, which can help control inflation. The ECB also uses standing facilities. These allow banks to borrow or deposit money overnight at predetermined rates. This helps stabilize short-term interest rates and manage liquidity effectively. Minimum reserve requirements play a role too. Banks are required to hold a certain amount of reserves, which affects how much they can lend out. This directly influences the money supply and, consequently, inflation. In times of economic downturns or very low inflation, the ECB may implement asset purchase programs, also known as quantitative easing. This means the ECB buys government and private sector securities to inject liquidity into the economy and influence longer-term interest rates. Sometimes, when traditional rates are close to zero, the ECB has used a negative interest rate policy. This means banks are charged for holding deposits at the ECB, encouraging them to lend more money and stimulate spending. Forward guidance is another strategy the ECB employs. By clearly communicating its future policy intentions, the ECB helps shape market expectations and economic behavior. This can stabilize inflation expectations among consumers and businesses. Since the inflation surge in 2021, the ECB has been tightening its monetary policy. This involves raising interest rates and reducing liquidity to steer inflation back toward that 2% target. These actions slow down economic activity, which can help reduce inflationary pressures over time. The ECB regularly reviews its monetary policy strategy to adapt to changing economic conditions. It aims to strike a balance between preventing inflation from rising too high and avoiding deflation, which can harm economic growth. In practical terms, these measures impact everyday life. They influence loan interest rates, mortgage costs, and returns on savings. All of these factors affect consumer spending and business investment decisions, ultimately shaping inflation trends across Europe.